There is a stretch of water, at its narrowest only a few miles wide, that for a century and a half carried a huge share of the trade between Europe and Asia. And in the last couple of years, the world's largest shipping lines simply stopped using it. They are now sending thousands of vessels the long way around the entire continent of Africa. That is not a delay. That is a permanent feeling rerouting of global commerce. And a small number of companies are quietly getting paid more every single week it continues.
I am going to walk you through 3 publicly traded companies that get paid directly, measurably, because the world's cargo is taking the long way around. Not a sprawling logistics conglomerate buried inside a dozen unrelated businesses. Not a generic transport fund that owns 40 names and a strong view on none of them. Real businesses with steel ships and steel boxes, whose economics improve the longer the disruption holds and whose pricing power rises every time the map gets more dangerous. A single choke point going dark has quietly rewired the cost of moving everything between 2 of the largest economic regions on Earth. The trade I want to show you is simple. Do not try to forecast when the shooting stops. Nobody can. Own the companies that are structurally winning while it continues, and that hold an edge even after it ends.
Let's get into it. First, a level set, because you cannot trade a thesis you do not understand. The story you have heard is a tax on shipping. The story underneath is what a single choke point actually means to the global economy. Look at a world map of how goods move by sea, and you will see that ocean trade is not spread evenly. It funnels through a handful of narrow passages, canals and straits, where geography squeezes thousands of ships through a tiny gap. These choke points are extraordinarily efficient. They are also extraordinarily fragile. One of the most important is a canal and strait corridor that links the Mediterranean to the seas leading toward Asia. For generations, it carried a large share of the cargo and a very large share of the seaborne oil and gas, moving between Europe and Asia. It is the short way. Then the attacks began. Armed groups began striking commercial vessels transiting the strait at the corridor's southern end with missiles and drones. And the world's major shipping lines, which carry insurance and crews and a duty of care, made a cold commercial decision. They would not send their ships through a shooting gallery. They diverted. They began routing vessels the entire way around the southern tip of Africa instead. Here is the part that should be tattooed on every trader's monitor. That detour is not a minor inconvenience. It changes the fundamental math of the entire shipping industry. Routing around Africa instead of through the canal can add many thousands of nautical miles to a voyage, often a week or 2 of extra sailing each way. Now think about what that does. First, the goods are at sea far longer, which ties up inventory and stretches supply chains. But here's the part that matters most for the trade, and it is not obvious. A longer voyage means each ship can complete fewer trips per year. If a round trip that used to take 6 weeks now takes 8 or 9, every vessel in the world is in effect slower. The same global fleet now delivers less cargo per year than it did before. And here's the magic of it. Not one ship was sunk. Not one ship was scrapped. The physical fleet is exactly the same size. But because every voyage got longer, the effective, usable capacity of the world fleet quietly shrank. The world suddenly has the same number of ships doing the work of fewer ships. And when usable capacity shrinks while the amount of cargo stays roughly the same, the price to move that cargo goes one direction. So you have a fixed global fleet suddenly doing less work, and the same world full of cargo that still needs to move. When that happens, 3 things get extremely valuable extremely fast. First, the shipping lines themselves, the companies that own the container vessels and charge the freight rates. Second, the companies that own and lease out the ships and the boxes, the asset owners who rent steel to the carriers. third, the specialist tanker operators, because the rerouting hit the energy trade especially hard. So I'm going to give you one company per layer. 3 names, 3 different ways to express the same macro bet. Name 1, AP Moller Maersk. It trades in Copenhagen and there is a US traded depository form. The ticker investors usually track is AMKBY. You might think of a container shipping line as a simple, unglamorous business. It moves boxes from port to port. That is true, and the simplicity is exactly why it is such a clean way to express this trade. This company is one of the largest container shipping lines on Earth, operating a vast fleet of vessels on the major trade lanes between Asia, Europe, and the Americas. When the cost to move a container rises, this company's revenue rises with it, almost mechanically. And here is the crucial thing to understand about container shipping economics. It is a high operating leverage business. The cost of running a ship, the fuel, the crew, the vessel financing, the port fees, is largely fixed once the ship is sailing. It costs roughly the same to sail a full ship as a half-empty one. So when freight rates rise, most of that extra revenue is not eaten by extra cost. It falls almost straight through to profit. A doubling in freight rates does not double a carrier's earnings. It can multiply them many times over. The industry is famous for it. Long stretches of thin, painful margins broken by sudden, violent bursts of enormous profitability whenever capacity gets tight. The rerouting around Africa is exactly the kind of event that creates one of those bursts. Here is what changed. In the period right before the disruption, container shipping was in a slump. During the pandemic, freight rates had spiked to extraordinary highs. The carriers had made record profits, and, as the industry always does, they had responded by ordering a huge number of new ships. Then the pandemic boom faded. Demand normalized, and all those newly ordered ships began to arrive. The industry was staring at a classic glut. Too many vessels, not enough cargo, rates sinking, profits collapsing back toward break-even. That was the consensus outlook, a painful oversupply, lasting years. Then the rerouting happened, and it quietly rewrote the script. Remember the math. Sending ships around Africa makes every voyage longer, which shrinks the effective capacity of the world fleet. That shrinkage did something remarkable. It absorbed the glut. All those extra new ships that were supposed to crush the market, the longer voyages soaked them up. The fleet that was too big for the old route map turned out to be roughly the right size for the new, longer one. An oversupply that should have devastated rates was neutralized by geography. And instead of collapsing, freight rates spiked, and the carriers swung from the edge of losses back to large profits. So what does this mean for the stock? It means a company that the market had written off as a value trap, a cheap stock in a structurally oversupplied industry, was handed a sudden, powerful tailwind. When freight rates surge, this carrier's profits surge with the operating leverage, and the company generates large amounts of cash. And here's what a well-managed shipping line does with a cash windfall. The best operators, having lived through the industry's brutal cycles, tend to return that windfall cash to shareholders aggressively, through dividends and through buying back their own shares, rather than blowing it on yet another wave of new ships at the top of the cycle. That matters enormously. It means that even if the disruption eventually ends and freight rates fall back, a shareholder who owned the stock through the windfall will have collected a large amount of cash along the way. The trade is not a bet that the rerouting lasts forever. It is a recognition that, for as long as it lasts, an unloved cyclical company is printing cash, and a disciplined one hands a lot of that cash to its owners. Now the bear case. 3 things to watch. 1. This is the most cyclical business in the entire trade. If the strait reopens and ships return to the short route, the effective capacity of the world fleet snaps back, the glut reappears, and rates can fall hard and fast.
2. The underlying oversupply has not gone away. It is being masked by the longer voyages, so the moment the masking stops, the problem is still there. 3. Container demand is tied to global consumer spending, so a real recession would hit cargo volumes on top of any routing normalization.
So how do you trade it? I am not going to give you a price target. Price targets are how analysts get quoted, not how traders make money. I will give you the framework. This is the highest torque, most cyclical name in the trade. It is the purest expression of the freight rate spike, and you must treat it as a cyclical position, not a forever holding. Watch two things. First, the freight rate indexes, the widely published benchmarks for the cost of moving a container on the major lanes. They are the live pulse of the thesis. Second, the routing situation in the strait itself. Are the major lines transiting it again or still going around Africa? As long as ships are still detouring and rates stay elevated, the cash machine is running. The moment the major carriers credibly return to the short route, the clock on this trade starts ticking down. That is the signal to take the cyclical gains and step back.
Name 2. Triton International is the classic example of this layer, though it was taken private, so for a public, liquid version of the same idea, the name to know is Textainer's successor exposure through the lessor Triton's listed peer. The cleanest listed name today is the container lessor and shipowner Danaus Corporation, ticker DAC. This is, in my view, the most underappreciated way to play the disruption, because it captures the same tailwind from a quieter, more durable seat. And to see why, you have to understand a split in how the shipping industry actually works. The shipping line whose name is painted on the side of the vessel does not necessarily own that vessel, and it very often does not own the containers stacked on its deck. There is a whole separate industry of asset-owning companies. They own the ships and they own the steel containers, and they lease them out to the operating carriers under contracts. This company is one of those asset owners. It owns container vessels and charters them to the big shipping lines under multi-year agreements. Now, why is that seat so attractive in this environment? Think about the carrier we just discussed. Powerful upside, but violently cyclical. Its fortune swinging wildly with the spot freight rate every week. The asset owner sits one step back from that volatility. It does not earn the wild spot rate. It earns a contracted charter rate, a fixed payment agreed in advance, locked in for the length of a multi-year lease. When the disruption strikes and carriers are desperate for every available ship, they rush to charter vessels, and they sign longer leases at higher fixed rates to lock the capacity in. So the asset owner converts the chaos into exactly what an investor wants: long, fixed, visible contracts. Why does that contracted structure matter so much? Because it changes the shape of the bet. When you own the carrier, you are betting that freight rates stay high week to week. A live, nerve-wracking spot market bet. When you own the asset owner, you are holding a portfolio of signed leases. Even if the spot freight market cools next quarter, a charter contract signed today at a high fixed rate for the next 3 or 4 or 5 years keeps paying that high rate for the full term. The disruption does not just lift the asset owner's income for a moment. It lets the asset owner lock in elevated income that persists well beyond the disruption itself. That is the key insight. The carrier captures the spike. The asset owner captures the spike and then freezes it in place with a contract. And there is a second effect that is just as important. When carriers are scrambling for ships, the market value of the ships themselves rises. The asset owner's fleet, the steel it already owns, is suddenly worth more. So the asset owner benefits twice. Its leasing income goes up and gets locked in, and the value of the assets on its balance sheet appreciates at the same time.
The numbers that matter for an asset owner are different from the carriers. The first is the contracted revenue backlog, the total value of all the lease payments the company is already scheduled to receive under contracts it has signed. This is the visible future, written down in agreements. A large, growing backlog means years of income are already locked in. You want to see that backlog extending, longer leases signed at good rates, pushing the company's visible income further into the future. The second is the fleet utilization, the share of the company's ships and containers that are actually out on lease earning money, rather than sitting idle. In a disruption, when carriers want every available unit, utilization runs very high, close to fully deployed. High utilization plus a long contracted backlog is the combination that defines a healthy asset owner. It means the fleet is fully earning and the income is locked in for years. That is what makes this seat so durable. The carrier is a bet on this quarter's freight rate. The asset owner is a portfolio of multi-year contracts that keep paying long after the headlines move on. And here is the kicker. An asset owner in a strong leasing market is, like the carrier, a powerful generator of cash, but it tends to be a steadier one. Because its income is contracted rather than spot, its cash flow is more predictable. And that predictability lets management commit to consistent shareholder returns, often a substantial, reliable dividend. So you are paid a real income stream while you hold the position, backed by signed leases rather than by hope. Now, the honest catch. An asset owner depends on the financial health of the carriers it leases to. Its income is only as good as the customer's ability to pay. If a major carrier were to fail, the asset owner could face a disruption to its lease income and the cost of finding a new customer for those ships. But read that correctly. It is a real risk, and it is exactly why you watch the quality of the customer book. But in a strong market, when carriers are highly profitable, that counterparty risk is at its lowest. The disruption that lifts the asset owner's income is the same disruption that makes its customers healthy enough to pay it. The bear case. 1. The asset owner is less cyclical than the carrier, but it is not immune. If shipping demand collapses for years, leases eventually expire and renew at lower rates. 2. The model carries counterparty risk. A failure of a major carrier customer would hurt. 3. Asset owners often carry significant debt to finance their fleets, so a sharp rise in interest rates raises their financing cost and pressures the stock. How I think about the trade. This is the durable, income-oriented sleeve of the shipping disruption. Lower octane than the carrier, but its gains get locked into multi-year contracts. If you believe the disruption persists for a meaningful stretch, and the routing situation suggests it well might, the asset owner lets you capture that and keep capturing it after the spike fades. Watch two numbers on every earnings call. The contracted revenue backlog quarter over quarter and the fleet utilization rate. As long as the backlog is extending and utilization stays high, the asset owner is freezing the disruption's income into its contracts. If utilization falls and leases start renewing at lower rates, that is the signal the leasing market is turning. Name 3. Frontline, ticker FRO. We have covered the container side, the carrier, and the asset owner, but now step back, because the rerouting did not only affect boxes of consumer goods. It hit the movement of energy, and arguably hit it harder. A large share of the world's oil and refined fuel moves by sea, carried in tankers, and a meaningful portion of that energy trade used to flow through that same canal and strait corridor. When the corridor became dangerous, the oil and fuel had to reroute too. the long way around Africa, just like the containers. And here's why that matters specifically for tankers. Remember the core mechanism. A longer voyage means each vessel completes fewer trips per year, which shrinks the effective capacity of the fleet. That mechanism applies to the tanker fleet exactly as it applies to the container fleet. The same number of tankers sailing longer routes can move less oil per year. Effective tanker capacity quietly shrank. And there is an extra layer that makes tankers especially interesting. The energy trade was already being reshuffled by sanctions and shifting trade patterns. Oil increasingly traveling longer routes from new sellers to new buyers. The rerouting around Africa stacked one more lengthening effect on top of a trade that was already getting longer haul. This is the layer the market consistently underthinks. This company is one of the largest tanker shipping companies in the world, operating a fleet of large crude oil tankers and product tankers, the vessels that carry oil and refined fuels across the oceans. When the rate to charter a tanker rises, this company's earnings rise with it. Here is why tanker economics are so explosive in this environment. The tanker business runs on the same high operating leverage principle as container shipping, but in an even more extreme form. A large crude tanker costs roughly the same to operate whether the daily charter rate is low or high. The fuel, the crew, the financing are largely fixed. So when tanker charter rates rise, the extra revenue falls almost entirely through to profit. And tanker rates are famously volatile. They can move not by tens of percent, but by multiples, swinging between barely break even and spectacularly profitable as the balance of ships and cargo shifts. Now layer on the rerouting. The fleet is fixed. The voyages got longer. Effective capacity shrank. And the oil still has to move. The world's demand for energy did not pause because a strait got dangerous. When a fixed amount of cargo chases a shrunken effective fleet, in a business with this much operating leverage, tanker rates can spike violently, and a tanker operator's earnings can multiply. And there is a structural point underneath the disruption. The tanker order book, the number of new tankers being built, has been historically low for years, because of uncertainty about the long-term future of oil. So unlike the container side, there is no wave of new tankers arriving to flood the market. The supply of vessels is genuinely tight, disruption or no disruption. And here is the kicker. This company has at times operated with a deliberate strategy of paying out a very large share of its earnings to shareholders as dividends. In a strong tanker market, with rates elevated and the operating leverage working, that can translate into an exceptionally high income stream for the holder of the stock. So you are not just positioned for the capital gain if tanker rates stay strong. You can be paid a substantial cash yield while you wait. Now, the honest catch, and it is a real one. Tankers are the most volatile, most cyclical idea in this entire episode. Tanker rates can fall as fast and as far as they rise. A warm winter, a demand wobble, an unexpected release of oil from storage, the strait reopening, any of these can knock rates down hard. But read that correctly. The volatility is the nature of the asset. You do not own a tanker company as a sleep-at-night holding. You own it as a sharp, high-torque expression of a specific view, that the rerouting and the longer-haul energy trade keep tanker capacity tight, and you size it and you respect it accordingly. The bear case. 1. Tanker rates are extraordinarily volatile. This is the highest risk name here, and a rate collapse can hit the stock and the dividend hard and fast. 2. The thesis depends on oil continuing to move in large volumes by sea. A sharp drop in oil demand would hurt regardless of routing. 3. If the strait reopens and voyages shorten, effective tanker capacity expands again, and the rate support weakens.
How to trade it.
This is the highest octane way to express the rerouting thesis. A sharp, volatile, income-heavy tanker bet that you must size with discipline. You watch two things: the tanker spot rates, the widely published daily charter rates for large crude tankers. They are the live signal. And the tanker order book, the number of new vessels on order, which tells you whether new supply is coming. As long as rates stay elevated and the order book stays thin, the tight tanker market that drives this trade is intact. If rates collapse and a wave of new build orders appears, the setup is breaking.
Now, and this is important, I would not bet the whole thesis on any single one of these names.
I would think of them as a basket.
Why a basket?
Because the three give you the same disruption at three very different levels of volatility, and that spread is exactly what you want. The container carrier is the highest beta expression on the consumer goods side. Pure immediate exposure to the spot freight rate with violent operating leverage. The asset owner is the durable middle. It captures the same upside but freezes it into multi-year contracts, so its income outlasts the spike. The tanker operator is the highest octane name overall. Extreme leverage to the energy reroute, a potentially huge income stream, and the sharpest swings in either direction. Notice that these are not three different bets. They are the same bet. Longer voyages, shrunken effective capacity, expressed at three risk levels. If the container market cools but the energy reroute holds, the tanker name can keep working while the carrier fades. If the spot market wobbles, the asset owner's contracted backlog keeps paying. Blending all three gives you the disruption thesis across a spectrum of risk, instead of betting everything on the single most volatile version of it. When you hold all three, the exposures roughly diversify each other while keeping the central macro bet intact. A single dangerous choke point has forced the world's cargo and energy onto longer routes. The effective capacity of the global fleet has quietly shrunk, and the carriers, the asset owners, and the tanker operators get paid for that gap.
One caveat.
If you are going to trade the shipping disruption, you have to be honest about its single biggest risk. It can end. This entire thesis rests on the rerouting persisting. If the security situation in the strait genuinely and durably resolves, and the major carriers move their ships back to the short route, then voyages shorten, the effective capacity of the world fleet snaps back, the container glut reemerges, and freight and tanker rates can fall hard. These are cyclical assets riding a geopolitical event. That is the nature of the trade. I do not know when the strait reopens, and neither does anyone else. But that uncertainty is precisely why you treat these as cyclical positions, size them with discipline, and watch the routing situation like a hawk. The map is the thesis.
Position size accordingly.
Do not max out on any single name. And keep dry powder for when a false rumor of the strait reopening sends the whole shipping complex down together, because that is when you accumulate.
A few catalysts I am watching going forward.
1. The routing situation in the strait, whether the major shipping lines are transiting it or still going around Africa. 2. The container freight rate indexes, the live pulse of the carrier trade. 3. The tanker spot rates and the tanker order book. 4. The container ship order book, how many new vessels are still due to arrive. If any single one of these key metrics cracks decisively, I will revisit the thesis on this channel. 2 more names to keep on a watch list, but I am not buying today. Zim Integrated Shipping, another container line, smaller and even more volatile with a history of dramatic dividend swings. And Star Bulk Carriers, a dry bulk shipping company, exposed to a different cargo mix, but riding the same choke point mechanics. I will cover both in future episodes when I have more conviction. Let me leave you with the macro frame. For more than a century, global trade was built on a quiet assumption
that the great choke points would always be open, that the canals and the straits, the narrow passages that the whole efficient map of world shipping depends on, would simply always be there, always safe, always passable. The entire architecture of modern supply chains, lean inventories, just-in-time delivery, goods sourced from the cheapest corner of the planet, all of it silently assumed those passages stayed open. And then one of them did not. A single corridor became a shooting gallery, and the world shipping lines did the only rational thing. They sent thousands of vessels the long way around an entire continent. No ship was lost. No vessel was scrapped. The fleet is the same size it always was. But because every voyage got longer, the usable capacity of the world fleet quietly shrank, and the price of moving everything went up. That mismatch, a fixed fleet doing less work against a world that still needs all its cargo moved, that mismatch is the trade. The carriers, the asset owners, and the tanker operators are not a bet on a war. They are a recognition that geography just got more expensive, and that the companies that own the steel get paid for every extra mile. The map changed. The market is still catching up. 3 companies. 3 layers of exposure. 1 macro bet. The carrier charges the freight. The asset owner leases the steel. Frontline moves the energy. If the thesis is right, all 3 compound. If the thesis cracks, you will see it in a handful of specific metrics, and I will tell you here. That is the trade. That is the headline behind the headline. If this kind of breakdown is useful to you, the kind where we do not just react to the headline, we trade behind it, hit subscribe. I will see you on the next one.